Still on trading account, statement of profit or loss, and other comprehensive income for the sole trader. So we have an information from Karen, who is a sole trader. She's a sole trader. So she provides us with this information: revenue, purchases, returns inward, returns outward, carried inwards, and inventory. Then we have additional information. Please put your mind here. We have additional information: inventory at 31 March 2018. This is inventory at 1st of April 2017. So this is when the business started, and this is when it ended. Do you get the point here? So this inventory, we call it opening inventory. And inventory at 31 March 2018 was valued at this cost. This is our closing inventory. Do you get the difference here? Opening inventory is the one you brought forward from the previous accounting year. That you think of selling, you are hoping to sell in this year. At the end of this year, whatever you close with in terms of inventory is what? Your closing inventory. I think it's clear, right? Great. Then it said, during the year, Karen had taken $300 of goods for her own use. So she took $300 worth of goods for her own use. We call it drawings. What do I call it? Drawings. So we call it inventory drawings. We call it inventory drawings. So we know what inventory drawings is now. That means the owner of the business takes stocks or goods or stocks for personal use. That is inventory drawings. So these are the opening inventory, our closing inventory drawings. And here, we're talking about returns inward. Returns inward. That means what you sold to your customers, they are returning it back to the business. We call it sales returns. It's the same as what? Returns inwards is the same as sales returns. Are you with me? Yes. So you might see these in the exams, you might see these. They are the same. Then we have returns outwards. Returns outwards. For returns outwards, you could have, we call it purchases returns. Is it clear? So another name for returns outward is what? Another name for returns outward is what? Purchases returns. Then for carriage inwards, when you talk about carriage inwards, these are the amount you spend to bring the product from your supplier down to the premises. So the amount of money you spend, the cost of bringing the product, or the cost of transporting the product to your business, to your premises, is your carriage inwards. So now we have to prepare these accounts. How do you prepare these accounts? Already we have these items. So we have to put these items into the extract for carry in terms of statement of profit or loss and comprehensive income. So we start with revenue. Revenue is the same as sales. So you write revenue. Revenue. How much is revenue? 45,000, right? Yes. Then we have sales returns. Returns inward, 1,000, right? Yes. Right? Less sales returns. Or less revenue returns. Amount 1,000, right? Yes. 1,000. This gives 44,000. Is it clear to here? Great. Then the next thing we are done with this, we're done with this. We have purchases. Now, this is our total sales. The next thing we have to do is to less our cost of sales. Right? Less cost of sales. So how do we get our cost of sales? Our cost of sales are other items here. The first one is purchases. Right? Purchases. The figure of purchases is how much? $20,000. $20,000. You have carriage inwards. Add carriage inwards. Add carriage inwards. Amount 24,500. Are you guys with me? Yes. Okay, great. Now, this is returns outward. What you bought from your cost supplier, you are returning. What you purchased from your supplier, you are returning it. So it's going to be less. Is it clear? So less purchases returns. Purchase returns. Amount 3,000. 3,000. We have 0, 0, we have 5, we have 1, we have 2. Is it clear to here? Is it clear to here?
Yes.
Okay. So, now, we have our opening inventory, amount 8,000. You add opening inventory.
Just confusing me.
Where?
I'm confused.
About what?
On this ledger.
Yeah, this is a table. As soon as I'm done with this, maybe the next one I want to do gets better. But what you have to take note is we have our sales. At the end of this transaction, at the end of this recording, we're going to have our gross profit. And yesterday we were talking about gross profit. We said gross profit is revenue minus cost of sales. This gives us gross profit. This is where we are going to. But to get here, we need to find our revenue, which are this. Then we need to find our cost of sales, which we are working on. As soon as we get our cost of sales, we take it away from this amount to get gross profit. Is it getting clear?
Yes.
Alright. Please sit properly. Can you sit properly, please? Then the next one. Add opening inventory. Opening inventory. 8,000. 8,000. Then, what else do we have? We add them together, please. This gives 0, 0, 5, 9, 29,500. Let's take note of what we've done. We are done with these two. We've done here, we've done. So, we have our closing inventory. But before our closing inventory, we have the inventory drawings. So you less inventory drawings. Inventory drawings. Amount $300, right? $300. So this gives 00292. Then we have our closing inventory. Less closing inventory, which is amount 700. Sorry. 700. We have 0, 12, 97, 5, 8, 28,500. So from here, this becomes our cost of sales. So you can write it instead of writing it here. You write it under here. So our cost of sales is 28,000. Let's see. 0, 1297, 5, 28,500. So we have 0, 5. Here we have 3. 13 minus 8, we have 5. 3 minus 2, 1. 15,500. So this becomes our gross profit.
So how is 3 minus 2?
Where?
From where is the 3?
Where is it?
In this section.
Here.
What is the 3?
What? This is 44,000.
Yes?
How did you get 44,000?
No. You said the 3 minus 2 is 1.
This is a 0.
But?
0. This is a 0 minus 5. That's 10. 10 minus 5, 5. It remains 1. 3 here. 3 minus 8. 13 minus 8, 5. 3 3 minus 2, 1. So 15,000